All right, so we look forward to a very good program indeed, whereby we can assist you prepare for the upcoming assessment. And this recording is going to be on YouTube. So, and we're going to post it in our Telegram group. All right, so if you're not in our Telegram group and you would like to access this recording, you can just WhatsApp this number, right? You can WhatsApp this number and tell them exactly what you want to do. Just tell the people there that you would like to join you'd like to access recordings for that particular module, and they will direct you accordingly, right? And also for those who might want tutorials, private tutorials, you can also inquire in our Telegram groups. That is to say, if you want assistance throughout the semester, you can enroll. You can ask the admins in the Telegram group to say, I would like to join tutorials. What do I do? But if you are okay with practicing on your own, then that is perfectly fine. Right, most students struggle with this module. It's a very soft module, but many students struggle because there's a little bit of accounting, and most students, the majority, do not have knowledge of accounting background. They do not have accounting background, and also a little bit of mathematics, financial mathematics, right? And but I can assure you, this is a very soft module. So, and one way you can use to practice, because we have available from the lecturers, we have past exam papers for October 2017, October 2016, and I think the other one is May, June 2017, right? So those three past exam papers, as you approach your final semester, end of semester exams, if you can practice all these, then you can be assured of a very good score. So what you can do as well, you can practice the paper and then email the lecturer to say, hi, Mr. Lecturer, I have done this part, done this question. Here's my workings, here's my reasoning. Can you correct me? You can also ask fellow students in the groups, or if you join our tutorials or anybody's tutorials, then obviously you should be able to work with arrangements in those tutorials. Part of financial management has to do with determining the goal of financial management as well as the operating environment. So, like I said, we're going to discuss the concepts and principles, but we're going to be guided by the questions, right? And so, one of the things that you need to know in finance is that we have what we refer to as a short-term financial goal. A short-term financial goal could be in 3 months, in 6 months, in a year's time, in 2 years. That could be considered a short term. Then long term, maybe it's from 3 years, maybe in 5 years time, maybe in 10 years time. So you have goals, long term goals and short term goals. So the short term goals is today and tomorrow, can we maximize the revenue and minimize the expenses? This is the short term goal of financial management. In other words, the primary short-term goal of financial management is to maximize profits, right? Because if we maximize the revenue and we minimize the expenses, what we have done basically is to maximize the profits. So that is the short-term goal. Whereas the long-term goal will be to maximize share value, all right, share price, share value, share price. In other words, that means maximizing the wealth of shareholders, right? So the long-term goal of financial management, in other words, the primary long-term goal of financial management is increasing the wealth of the shareholders. And the wealth of the shareholders is increased by maximizing the share price. So if the price of their shares goes up, then they become wealthier. So that's the long-term goal over time, right? And sometimes these two goals can conflict, but we have to harmonize these goals over time. So that's very important. So that's our starting point when we define what are we talking about when we are in the field of financial management. And this particular financial management is for non-financial managers. So it's actually very soft. All right. This is a soft module. Then we spoke of maximizing profits. So profits are maximized if we can reduce expenditure, for example, on non-core business activities. Because most of the activities that we can do to improve profitability will also increase the costs. For example, if we want to increase the sales, if we want to sell more and have more revenue and bring in more sales, we can advertise. But the advertising is going to increase the costs. So the advertising is going to increase the costs and increase the revenues. So it's going to increase both. Whereas if we can just reduce expenditure on non-core business activities, then that's going to definitely improve our profitability. Whereas with other avenues of improving profitability, we might also have to increase the expenses and the income. And so it depends on how much each has increased before we can say the profits have actually increased. Right. So basically, that's the concept of short-term goals and your the goal of the financial manager. Right. And we also talk about some of the short-term financial goals. Right. The primary is profitability, but we also have other goals like liquidity. Right. Where we have liquidity refers to our ability, right, to pay our creditors, or if we owe some people, then we need to have sufficient cash available to pay those people when the time is due. Some of those people we need to pay include the employees, your electricity, your water and electricity, right? Your interest on borrowings from the banks and stuff like that. So we can improve the liquidity. In other words, we can generate more cash, or we can save cash in our entity if we can accelerate cash flows from accounts receivable. That is to say, we can collect our accounts receivables more quickly, right? Or we can delay paying our creditors without damaging supplier relations. Maybe we can negotiate with them, or we can do some effective inventory management, right? So that we don't buy and we keep the inventory for a very long time. If we can buy quickly and sell quickly, then it means that we're generating cash much, much quicker. Remember, liquidity is about paying our short-term obligations, right? Whereas solvency is about how much assets do we have, and can those assets pay our liabilities, right? So solvency has to do with long term, our ability to pay over the long term, because solvency has to do with the total assets and total liabilities, right? whereas liquidity has to do with the settlement of short-term liabilities. So these are some of the things that you will need to remember. All right. Then we have spoken about the long-term goal of the firm. We said the long-term goal of the firm is to increase the value of the ordinary shares, which is actually the main function of a financial manager. And you achieve that by minimizing the cost of capital and maximizing the internal rate of return. So what that means is, over time, I'll give you a good example of what this means. This question 5, minimizing the cost of capital and maximizing the internal rate of return. I will give you an example of what that means. Right, so let's say you want to start a small business. You borrow 100,000, right? And you borrow this 100,000 at 10% per annum. So which means that at the end of the year, you have to pay 10,000 rand in interest because you borrowed. But now you take this 100,000. So this 10% is 10% is the cost of capital. You need capital, you're gonna borrow, so there is a cost attached to that capital. Whether the capital is borrowed or you actually it's your savings or anything, it has to have some cost attached to it, right? Then what happens now with maximizing the internal rate of return? This happens when, for example, you take this 100,000, you start a small business. Then at the end of the year, you make a profit from that business of 50,000, all right, from that, or let's say 50,000. So you started a business with 100,000, right? And then you make a profit of 50,000. So what this means is, by the end of the year, your profit is 50,000, and you have expenses of 10,000. So you are the winner, in the sense that you are left with 10,000 remaining after paying the 10,000 and other expenses. So if you maximize this internal rate of return, if it was 60,000, the profit that you get after all the expenses, then that's a good thing. You become much better off. All right. So if you're a listed entity, then you're going to have the value of your ordinary shares highly increased. Even though you might not be a listed entity, but you can still expect the value of the ordinary shares, the valuation of the ordinary shares to increase as well. Right? So that's the concept of long-term financial management. Right. So we also discussed the concept of wealth maximization, which is the long-term goal, versus the profit maximization, which is the short-term goal. Right. And you need to remember some of these things. And one of the things that you need to remember is wealth maximization should be long-term and sustainable in the growth of the share price. Right? And it's different because it focuses on cash flows for the shareholders, while profit maximization focuses on the earnings or the profits, which may not translate into cash flows. For example, I could sell to somebody 100,000. I could sell something for 100,000, right? And I only managed to receive, let's say, I'm selling something for 100,000, all right, or for 100 rand to make it easy, and I bought that thing for 50 rand. So the profit is I bought something for 50 rand, I sold it for 100 rand. Then I made a profit of 50 rand, right? Then based on this, this is a profit. But what might happen is that that guy who I sold to eventually doesn't pay me, maybe disappears, maybe pays 50%, maybe the business is closed down. So although my earnings shows you that I have earnings, or profit of 50 rand, the actual cash flows were not received. So if you want to maximize wealth, you have to make sure that the profits you make transform into cash flows. Because once you have more cash flows being generated from operations, then you stand a chance of enriching your shareholders. And you also need to remember that wealth maximization is over the long term, whereas profit maximization is a short-term outlook. And wealth maximization, as you have seen here, focuses on risk. In other words, am I going to receive the cash if I sell? Whereas the profit maximization ignores the time value of money, ignores cash flows, ignores risk as well. So you need to be able to know the difference between wealth maximization and profit maximization. It's very important. It's very important that you are very comfortable with that. Right, moving on. We now discuss professions in financial management. And so that's quite soft, but you need to know. So I'm not going to explain here anything. You need to know what are the duties of a treasurer, right, or a financial manager. So it's some of the questions that you will get. All right, and this question says, which of the following is not a duty of the treasurer, right? And sometimes you are also required to distinguish between financial accounting and financial management, right? So these are things that you need to focus on. I've given you the notes so you can, if you watching this video, you can at your time or even now you can take a screenshot, but it's gonna be available on YouTube in our Telegram group, so you can stop the recording so you can copy anything that you would like to copy, right, that you think is important for you, right? Now this is one of the questions that students enjoy: defining finance as an art and science of managing money. That's quite a beautiful definition, all right? But you need to know that in financial management there is a lot that is done. There is financial services, right? So financial services has to do with designing and delivery of advice and financial products to clients. Those clients could be your individuals, could be a business that needs some financial products, or the government. So that's called financial services. Then you have personal financial management, when we focus specifically on the financial planning of individual investors. All right. So we're focusing on the financial planning of individual investors. Right. And these, we also talk of managerial finance, which is the same thing as financial management. Right. Managerial finance and financial management are the same things. So there are a lot of things that people do in financial management. They do investment management. They do capital expenditures management. They do treasury. Right. As some of these things, you can just open your textbook. So if you do not have a textbook, there must be a soft copy on the Telegram groups. There are a lot of Telegram groups, so you should be able to acquire one for yourself and save some money. You save yourself from buying, because you can use the soft copy without any problem. And here are some of the responsibilities of a financial manager, right, which you need to make sure that you understand. Then when an entity is operating, when a firm is operating, it will need some source of funding to support their operations. So where does a firm get its financing from? So it can get its financing from the owner, who can contribute a capital injection. right? A capital contribution, or it could be from borrowings, right? And there are a lot of borrowings that we can have. We can borrow from the bank, which would be a bank loan, or we could borrow from the market if we are big enough. And some of these things could be your debentures, all right, your bonds, and other short-term securities or other short-term borrowings that we can have. Right, so this owner who contributes capital, this is also referred to as equity. So the primary sources of funding is going to be your equity and your borrowings. Equity means it's provided by the owner. Borrowings or debt means it's provided by other parties other than the owner of the business. Right? So if you would like to raise equity, then you have to issue ordinary shares. Right? And if you'd like to, so let me just remove this so that I can explain something much better. Right, so let me remove this. Right, so I wanted to say equity. Now this is from our module, right? It's gonna differ. We can have equity and debt. So equity has to do with your ordinary shares, your preference shares, your retained earnings, and other reserves that will be in your statement of financial position. So all this is going to be equity. And your debt has to do with your bank loans, your bonds, your debentures, right? And other forms of borrowings that we could use in an entity. So when we get money from, when we acquire funding from providers of finance, we could acquire the funding from a money market or a capital market. So you need to know the difference between those two, right? You need to know that a money market is concerned with short-term debt, right? The debt is short-term. So these are the two characteristics of a money market. The first one is that it has to be a borrowing, and that borrowing has to be short-term. Then it's going to be the money market. Then your capital market has to be anything. It could be debt or equity, but it has to be, it could be debt or equity, right? But it has to be long-term borrowing over a year. Right? So these are some of the things that you need to know, because they're going to ask you a lot of these things, and you need to make sure that you can respond effectively. For example, one of the questions that they've asked previously, and they keep repeating this: which type of funds would an organization typically finance temporary current assets? So because these are temporary current assets, like you want to buy, you want to pay for something, for inventory, or yeah, for some, maybe you want to pay inventory, you want to buy inventory. All right. So you wouldn't really ask the owners to raise equity. You can quickly do some borrowing. So you're gonna rely more on short-term debt. And if you are a small firm, so small firms are mostly gonna rely on short-term debt, right? Because they can't go and have long-term securities, because those require a lot of things, a lot of commitment. So most small firms then are going to rely on short-term borrowings. But if an entity is established, then it can rely on both debt, long-term debt, and equity. Remembering that equity is always long-term, right? If you raise equity, it's not just equity for a year, it's probably forever, right? So that's always long-term, right? And then there is a need for an entity, for an organization to apply business principles. Some of these business principles which will ensure that the entity is sustainable over a long period of time. That would require that the entity trade profitably, right? In other words, it should maximize its revenue from sales and manage its expenses. So it must trade profitably. Right? Then it must have sufficient cash to pay whoever needs to be paid. So there has to be effective cash management. In other words, it must plan its cash inflows and outflows by means of a cash budget. So this has to be properly planned, right? So that you don't run out of cash. So that's one of the business principles. And the other business principle is that the cost of financing, if we borrow and we have to pay back the people, the cost of financing should be as low as possible, while we maximize the return on the investments. Remember, we borrow to make investments, so we want the cost of financing to be low and the return on the investment to be high, so that we can actually survive. Right, I hope that you are comfortable with this as we keep on going. Now, where are we? Right, so we come to another category for our discussions, and that's going to focus on financial statements. So financial statements can generally be very confusing for students. I can see student questions on Telegram. They struggle a lot. So we need to identify the financial statements that we deal with when it comes to financial reporting. Right? Also, we have the statement of financial position, right? And the cash flow statement. These two are used to determine the entity's liquidity and solvency. So our financial statement, our statement of financial position rather, is going to tell us about your assets, equity, and liabilities. So what I see from here, if we have sufficient assets to pay the liabilities, right? So that's what we want to see from the statement of financial position. And we also look at the availability of cash. Are we able to generate sufficient cash so that if there is any need for us to pay our creditors, those guys who we owe money, we need to have sufficient cash available. All right. So the cash flow statement will give us an idea of the movement of cash in and out of the business, so that we can assess whether this business is healthy or not. Then we have the statement of comprehensive income, which is also referred to as the statement of financial performance. This is financial position. This is financial performance. A statement of comprehensive income is used to determine profitability. So with financial performance, which is the profit or loss statement, we're focusing on income and the expenses, right? So that's what we're gonna focus on. So altogether, we have assets, liabilities, and equity being disclosed in the statement of financial position. Then your income and expenses being disclosed in the statement of profit or loss, or the comprehensive income statement, right? Now, these are some of the principles of accounting which I have provided by way of notes. So I believe that you guys can go through that at your pace, right? And you will be fine, right? Then when it comes to financial management, remember that we need to talk of two things. There is a separation of ownership. Sometimes there is a separation of ownership, and management. Right. So, for example, when a business is growing, then you obviously need to hire more managers, right? And there are some businesses whereby the owners are not even there to do the managing. For example, if you look at a business like your Standard Bank, the owners aren't even there. Just thousands of shareholders. They're not even there to manage. So they will hire managers like your CEO, the other executives, right, that will help the CEO, then the board of directors that will also oversee the work of the executive committee, right? And so what happens is that once you have someone, this is a principle of separation between ownership and management. So once you get somebody to manage your business for you, there's a chance that they will not act in your best interests. In other words, um, they might do things that bring the business down, which you as the owner wouldn't have done if you were managing. But because you just own the business, you have other commitments, or maybe you don't have the skills, and then you get somebody with the skills, but they may not act in your best interests. So how do you make sure that that particular individual is going to act in the best interests of the shareholders? So we have the shareholder and the management, and you would like to make sure that the management is going to act in the best interests of the shareholders, right? And I've spoken about there's a possibility, but that the manager will not act in the best interests of the owner. So the owner is the principal, right? And the manager is the agent. So the agent acts on behalf of the interests of the principal. The agent is more like a messenger who must perform something to deliver on behalf of the principal. So the manager is the agent who acts on behalf of the principal, who is the shareholder, right? But because an agent may not act in the best interests of a principal, then we have what we refer to as an agency problem. The problem of having an agent is that they may actually do things that hate your business, that bring down your business. So that's the agency problem. And how can we resolve the agency problem? So we have things that we refer to as, let me check here. Right, I do have that. So one method that companies can use to ensure that the management decisions are in the best interests of the shareholders, they will simply say, because the shareholders would like the share price to increase. All right. So if the share price increases, that's good for the shareholders. Now, for the shareholders to make sure that the managers also will want the share price to increase, they would tie the management compensation to share price to say, we give you a bonus of so much if the share price increases. Now, this is an incentive to the agent to act in the interests of the principal, so that in acting in the interests of the principal, the agent is benefiting because they will get a bonus as well if the share price increases. So they have to work towards the interests of the principal, interests of the shareholders, so that they too can benefit. So this is just one method often used by companies to make sure that management is going to act in the best interests of the shareholders. Right. Some of the items also include profit sharing, to say if if you get more profit, then you're going to also share a portion of that profit. So the management is going to work hard to increase the shares. And then they have they're gonna work hard to increase the profits, rather, sorry. Or they could also be a share option scheme whereby the managers are forced to hold shares. And by holding shares, it means if the value of shares goes down, then the managers too are also going to lose. Right? Then we have what we refer to as agency costs. Now, agency costs are there to reduce the chances of management acting in their best interests or acting in their own selfish interests to the disadvantage of shareholders. So shareholders have to do something. In other words, they have to incur some cost to prevent managers from disturbing their business. So those are called agency costs. When the shareholders or the principal makes a plan to make sure that the agent acts in the best interest of the principal, those are called agency costs. So agency costs could include performance incentives paid to managers, right? It's an agency cost because it's an extra cost just to make sure that your managers are going to align their behavior in the best interest of the shareholders, or the shareholders can monitor the performance of the management, the behavior of the management. This includes having auditors come, to audit your performance as a company. Then they will report. Remember, auditors report to shareholders, as you know, right? So they're gonna be paid some money. So that is a cost of monitoring management behavior. Then there's also going to be insurance. Like, let's say that they purchase insurance and they insure against management misconduct. To say, let's say a manager does some misconduct and steals a customer, a big amount of a customer, right? A large chunk of the customers, and steps down and runs away with those customers. Then they can have the insurance can pay them, right? So the cost of the insurance is as a result of that, the agency costs, right? Right. So remember that as well. Brilliant. So that was agency cost. So this one I should have put it here. I will correct it because this was supposed to be, this slide is in the wrong position. Right, and these are some of the principles of accounting that you will need to remember. Going concern materiality, double entry. So we're not going to discuss those now, but you can have some time to look at that. So this is your double entry. Now, double entry is some of the concepts will be asked in your assessment one. All right. So you will need to know, how do assets increase, how do liabilities increase, and so forth, right? Those debits and credits. I'm not sure if you guys do this module after doing FAC 1502. So this will just be a reminder. You really need not go into depth of transactions and determine which account to debit, which account to credit, right? It's not going to be like that. Right? Then let's quickly cover these two questions. Right, so we have a decrease in assets, and as you know, assets increase debit, and the assets increase on the debit, and they decrease on the credit. So obviously, a decrease in assets is going to be recorded by means of a credit entry, because assets increase on the credit. And an increase in equity is obviously, equity is credit entry as well, if it is increasing, right? And if our sales are increasing, then we have to credit the sales. If we make a sales on credit, then we have to credit the sales because the sales have increased. If you have forgotten some of these things, remember, we just look at the principle. We're not going to do the actual transactions. For the purposes of this module, we just like this principle here. That's going to be very sufficient, right? Right. So you need to, in this question required the students to determine which of these is not a fixed asset. A fixed asset is also a non-current asset. All right. So fixed assets is a slightly older term that was used previously, and so you needed to identify which of these is going to be and which of these are non-current assets. So this is a fixed asset, this is a fixed asset, this is a fixed asset. This is a current asset. It's like an investment in short-term financial securities. And you need to remember, this is also a very important question. The reason why I chose to do this by way of questions is because the questions repeat a lot. So it's actually more effective to just play around, to answer the question and play around with the concepts. All right. So if we go to the statement of financial position, we will have fixed assets. All right. All right. So these fixed assets actually refers to, in this question, they meant to say property, plant, and equipment, because there are some fixed assets which are not going to be depreciated, right? But so if we say property, plant, and equipment, then we're going to say they're going to be disclosed as cost, right? At cost minus accumulated depreciation. Remember that in your statement of financial position, you're going to include the carrying amount of PPE, right? So it's going to be your carrying amount of property, plant, and equipment. So which means that if you're going to disclose the carrying amount in the statement of financial position, then you have to determine the cost, then subtract your accumulated depreciation, and you're going to be happy, right? You're going to be happy. And you need to remember as well that your current assets, what are some of those things that make your current assets? Include your inventory, which is sometimes referred to as a stock. Include your accounts receivable, which is also your debtors, as well as cash deposited or cash on hand. These are going to be your current assets. Now I have a little problem here. I don't know. Okay, I think it's solved because my laptop was not charging, so that was going to be a big challenge.